Thank you so much, David, Jeff, everyone, for having me here at the monthly TA Thought Leaders session. I titled this presentation Navigating the Macroeconomic Environment as TA Leaders. And I'm Andrew. I'm the chief economist at Appcast. I've been here for about 4 years. I direct Recruitonomics.com and I lead Appcast data team. Recruitonomics.com is a free resource I'll talk about later for TA and HR leaders to know about the labor market trends that matter for implementing the best tactics to hire talent for your organization. Before Appcast, I was an economist at Indeed, the hiring lab there. And prior to that, a journalist at a website, a data journalism site called 538. And I used to be an analyst, an economic research analyst at the Federal Reserve. So I live outside of Boston, so another Massachusetts person here. Though I'm from the South, I'm from Louisiana, so you may hear my kind of Cajun, fast-speaking accent come out. I can maybe slow down a little bit in my cadence. So I know this is my first time here, but I want you to engage in the chat or raise your hand. I do live outside of Boston, as I said, with my wife and 3 kids, a dog named Bingo from the show Bluey. So I got 3 kids under 10. I have economics degrees from the University of Chicago and DC. And so yeah, connect with me there on LinkedIn. So that's enough about me. Just really quickly about Appcast. In a nutshell, we're a 10-year-old company that is a recruitment marketing platform. We help companies distribute and optimize their recruitment marketing media. And we are the largest buyer of Indeed, ZipRecruiter, and LinkedIn job ads in the world. We manage more than $1.6 billion of recruitment marketing media. We have about 450 employees spread across 12 offices. So that's Appcast. I'm not a salesperson. I'm happy to talk to you more about the solutions we provide, or direct you to someone on the Appcast team that can talk about that. And in terms of Recruitonomics, I know I mentioned the website, but it's not just a website, it's also a framework. So before I dive in and talk about the economy, I just wanted to kind of mention this framework. And really, it's a marriage between two, you would think disparate fields, but I think are increasingly becoming interrelated. On the one hand, there's labor economics, the employment wage growth, and other trends that I'm going to dive into from your kind of textbook, capital E economics, right? But marrying that with real boots on the ground recruiting tactics that you all in this meeting know even more than me, or that we at Appcast help as a partner with our clients, we help you implement. So another way to think about it is with Recruitonomics, there's things you can't control, cannot control, and things you can control. And so this box on the left here, as we're about to dive into, when we talk about supply and demand in the labor market, when we talk about government policy, whether it's tariffs or DOGE, when we talk about who your competition is, this is beyond the control of any one company or any one TA leader. So even if you're Walmart or Amazon, these forces are beyond your control. And the thesis of Recruitonomics is that by better understanding these elements in the box here that we're about to walk through, you'll then be able to best optimize these kind of middle factors that you can control, right? Obviously, your employer brand, your apply process, your kind of recruitment marketing mix. And so that's the thesis here, is that by better understanding the things you can't control, you'll better optimize the things you can, because they all factor into the cost and quality and the volume of candidates you're trying to hire. So that's Recruitonomics as a kind of framework, but I want to dive into the substance, the meat of the presentation. And what you're about to see is a lot of data and charts. But what I like to focus in on is the story. And what's the narrative that unites all these disparate data points? Don't worry, I'm going to share all these slides, so you don't need to screenshot anything, and I'll make sure it gets circulated within the group. But the story here at a high level is the US labor market is moving from a period of being very tight to being in balance. And let me explain what I mean by that. So I always start with this chart. This is Economics 101. Supply and demand in the US labor market. The dark blue line here is demand. What do I mean by demand for labor? I mean total employment. That's everybody who has a job, whether full-time, part-time, whether gig or W-2 work, plus that total employment plus unfilled job openings or vacancies, right? And so you add that up, it's around 171 million, the dark blue line. You contrast that with supply. What's labor supply? The light blue line here is labor supply. That's the US labor force. That's everyone who has a job, plus the unemployed individuals who are actively searching for work in the last 4 weeks. I heard a lot of conversation, a lot of chatter about the 4.2% unemployment rate. I'll dive into that later in terms of how it's calculated. The denominator is not the total population. It's not necessarily everyone who doesn't have a job. It's everyone who doesn't have a job, but who's actively searching for work. So that labor force, this light blue line, is the denominator of the unemployment rate. And so when you add that up, it's around 170.3 million, okay? And so when I say the labor market is moving from being tight to being in balance, here's what I mean. The orange shaded areas are tight labor market times. These are points when the dark blue line, demand, exceeds the light blue line, supply, right? Where there's more intent to hire or total employed people than there is the supply of them. And so we went through a period post-COVID from like late 2020, early 2021, for a few years there where it was, you see a lot of orange, right? Where demand far exceeded supply. And so those were tight labor market times. We also had that pre-COVID as well. But what do you contrast a tight labor market with? I would say I'd characterize it as a slack. So these shaded light blue areas are slack labor markets, okay? That's when it's the opposite, when supply exceeds demand. And so I remember, for example, say I was at the Fed 2008 through 2014, and you see here there were parts of that Great Recession period where there were 4 or 5 unemployed people for every 1 job opening. Very, very hard to get a job. Now, fast forward to today, there's actually more job openings than unemployed people. That means if every unemployed person in America got a job right now, there would still be some unfulfilled openings or vacancies. So these kind of slack labor market areas have been quite a different period. It feels like a different age from what we've experienced recently. But what's happening is these two lines are converging. The supply and demand lines are getting into almost near perfect balance. And so let me take each of these one at a time, demand and then supply. So on demand, let's talk about the monthly change in total payroll employment. So just last Friday, we got the May jobs report, and we saw that the U.S. added 139,000 jobs, as David mentioned with that headline. Does it seem as good as it appears on the surface? I would agree with David. No, it doesn't. When you look under the hood of these numbers, what we saw is, and this is normal every month, there's revisions to the prior 2 months. But in the May jobs report, the revisions were unusually large to the downward side. So in March and April, we had downward revisions to the tune of 95,000 jobs. So the trends here, these blue columns, the monthly change in payroll employment, I overlay them with these lines. These are the 3 and 6 month moving averages, right, to kind of see the trend. And the broad picture over the last 3 years is we've had cooling job growth, a slowing growth of jobs until about late last year, where we started to see a bit of an uptick in job growth, and then it started to kind of seesaw back down slightly earlier this year. So that said, 139,000 in these broad trends of around, say, 157,000 over the last 6 months. On the surface, they don't look too bad, but as we dive deeper into why there's cracks in the foundation, you'll see why I'm less sanguine. So in terms of the industry mix in the May jobs report, really it was heavily towards healthcare. Now that's not a surprise. Roughly 30% of all jobs added the past 2 years have been in healthcare. So the broad healthcare and social assistance category last month added 78,000 jobs. Leisure and hospitality had a kind of surprisingly strong month, adding 48,000 jobs. But beyond those 2 big sectors, it was slim pickings, right? You go down the list here, manufacturing lost 8,000 jobs, retail trade shed 6.5 thousand, and then the broad kind of white collar space, professional and business services, fell by 18,000 jobs. Okay, interesting. So that's the one part of the demand story in terms of intent to hire and employment growth. But one thing I want to call out here is DOGE, right? It's in the news with Elon Musk, the Department of Government Efficiency is starting to have an effect in terms of payroll employment for the federal government sector. That has fallen now for 4 straight months. Again, I wouldn't overstate this as a dramatic change, to be honest with you. I mean, the federal government payroll is over 3 million when you include the military and the postal service. So while this isn't making a huge dent, it is something that in the job growth numbers does affect the monthly employment report. That's the kind of quick highlights in terms of the industry mix. Again, I talked about demand just now, but now I want to shift and talk about supply. And so here's the figure that you were all debating and discussing, the 4.2% unemployment rate. And I want to zoom out here. This is since the end of World War II. You're looking at the unemployment rate, and these shaded areas are recessions, right? You see this really sharp but short recession during the COVID 2020 period. But right now at 4.2%, I would characterize the level as historically low, right? Because you have this orange line, that's just 4%. And you see, there's not a lot of periods in US post-war history with a sustained below 4% unemployment rate, but we did have that for several years post-COVID. It has been ticking up. Over the last 2 years, it's risen from 3.5 to 4.2. Again, that trend is a little concerning, right? We definitely see the cooling labor market that I just showed you earlier, right? With the job growth figures going down. But this level of unemployment is, even though it's been rising, it's still historically pretty low. Let me stop here and just say I don't actually trust I trust the unemployment rate, but I don't use it as a figure to measure labor supply or slack in terms of the talent pool. A better measure, and this is something when you say people go wild at parties, it's the prime age labor force participation rate, which sounds like a mouthful, but let me break it down. It's not to be ageist, but demographers, economists talk about the prime age workforce. That's 25 to 54-year-olds to exclude, people who may be in higher education or folks who are at or near retirement age. So when you look at 25 to 54-year-olds, the share of them who are employed or who are unemployed but actively looking for work is actually quite high. It's ticked down a bit from its peak last summer, but it went from 84 to 83.4. So it's still pretty high. You have to go back, frankly, to the late 90s to see a period where prime age workers were engaging in the workforce at this level. So what's driven this huge surge in participation post-COVID? It's really two demographic groups I want to highlight. One, prime age women, their labor force participation is near an all-time high. And then two, foreign-born workers. We've seen an enormous surge in immigration over the last 4 years. And a lot of those workers, they're younger and they're also more likely to engage in the workforce. So those are the two groups that have really driven this participation rate higher in terms of supply. So I talked about demand and I talk about supply. And this is the moment in the presentation where people kind of get a little, they say, wait a second, Andrew, I'm having fun here, folks, with the Steve Harvey GIF. People say, wait a second, I know I work in TA, I work in HR, I know hiring is going down, and you're not wrong. So this is the simplest chart in the presentation. This is just the rolling past year of all the hires made in the US. And you see here it peaked near 80 million back in 2022. And then it's been steadily declining. Actually, last year, there were 5 million fewer hires than in 2023. So the confusion is people say, wait a second, I work in TA. I know hiring's on the decline, Andrew, but yet you're telling me we're adding jobs. We're adding over the past year, roughly 144,000 jobs a month. So how can that be that we are seeing hiring go down and we're seeing payroll employment rise? And here's one of the first key insights I want to talk about over the next half hour or so. And that's the Great Stay, which is the overcorrection from the so-called Great Resignation, which I don't say so-called because it didn't happen. It did. We all heard about the Great Resignation, right? People quitting their jobs. And the peak of that in 2021 and 2022 was a real thing. But we have since moved in the far opposite 180 direction. So let's break this chart down. You're looking at three lines, three colors, and they're all rates. The top line is the hire rate, the middle line is the quits rate, and the last line here at the bottom, the kind of light purple line, is the layoff rate. Now, the rate as a percentage of what? Percentage of total employment, okay? And so the top line, you see the hire rate has been in sharp decline. That makes sense, right? Because I just showed you that chart of hires going down. So the hires rate, it's the lowest level. It's been hanging out at a low level now for almost a year, the lowest in about a decade or more. And so that's interesting. And see here, all these lines, the point of this chart is that all of them are subdued. They're all below the dashed level, which is their pre-COVID benchmark. So for employers, they're both hiring less, but they're also firing less. So this last line here at the bottom, the layoff rate, is very low. And some of you get skeptical when you see this data. You say, wait a second, I hear about layoffs on LinkedIn. I saw a lot of headlines about, the Silicon Valley tech giants laying people off. Here's the thing. Tech's a big deal in our culture. It's a huge deal in our stock market. Less than 2% of all employment is in the tech sector. And so LinkedIn is not a representative sample. I just kind of want to say this one more time for the people in the back. LinkedIn is not a representative sample. The layoff rate is extraordinarily low right now. So employers are both hiring less, they're also firing less. The middle line is employees quitting. We saw it peak at an all-time high. That was the great resignation in 2022. It's now all the way down to 2%. So the point here is it's kind of like a frozen labor market, not much dynamism, not much churn on either side. It's kind of locked in, okay? And what I want to characterize for you is something that I see active in the chat, which is this, the composition of the jobs that are getting hired for right now. So this is, maybe I'm biased, this is data from Indeed. I used to be an economist at the hiring lab there. And I'm indexing all this data to February 2020, which I can't believe it's been 5 years, but that's the pre-pandemic benchmark. We index all this data to 100. And so you see how they all fell. All these job postings on Indeed declined sharply in 2020. And then boom, here's the tight labor market, the huge hiring binge, the surge of these lines. And so the black line here is overall job postings in the US on Indeed.com, the largest job board in the world and in the country. So when we look at these job postings, we see that they're kind of up like a rocket, down like a feather. There's been a steady decline in job postings on Indeed. That said, the number of job postings are around 6% above pre-COVID levels. However, let's peel the onion because there's no single labor market. There's no single overall labor market. And so the types of jobs that are below the black line here, let me know if you see a common pattern here. They are software development, marketing, banking and finance. I could go on. There's a lot of other occupations I didn't include. HR, sales. The commonality for the most part of these jobs where we see really weak demand, I would call them not white collar, I would call them sitting down jobs. So the sitting down jobs, the kind of laptop class, let's be honest, that's me. We've had extraordinarily weak demand for those workers. And so that's why LinkedIn is not representative, because that's overly skewing towards these so-called knowledge workers or sitting down jobs. And so there's been a white collar recession in the last 2 years. I'll grant you that. But look at the jobs on the other side that are above the black line. I would call these not blue collar, but standing up jobs. So sitting down and standing up. The jobs above the black line are nursing, construction, but I would also include education. I could include, the skilled trades. Other than manufacturing, all the traditional blue collar jobs, really strong demand. So think of like today it's never been a better time to be like an HVAC technician than today. We see increasing demand for the people who stand up and do either direct care providing jobs like in healthcare and education or do manual trades. So if that's the composition, it squares a lot of the kind of disconnect you may feel when you say, I see these good unemployment figures, but I see all my friends in TA who are unemployed on LinkedIn. That's the disconnect, the white collar recession, the disconnect between sitting down and standing up jobs. However, David mentioned his daughter who graduated from UMass and had a science degree and is having a hard time finding a job. And so this is the real interesting dynamic between, I would call it an insider versus outsider dynamic. Insider in the sense of if you have a job, it's actually a pretty good time right now. As I'm about to show you, wage growth is finally exceeding inflation. As I just showed you, layoff rates are really low. But if you don't have a job, it's really hard to find one. And so this is the job finding rate. It's the probability you go from being unemployed to employed, and it's trending downward. So all your friends on LinkedIn who say it's really hard to get a job, they're not wrong, but I would say number one, they're probably skewed towards those sitting down jobs that are seeing a real weakness in demand. But the other factor is think about the people who are trying to get work now. They're either recent high school or college graduates, or they're maybe immigrants, or they're people who took time off out of the labor force to do childcare or elder care, and they're re-entering the labor force. They're looking for work. It's hard to find a job right now. That's what I mean by an outsider dynamic. You're not yet in a job. It's much hard, but if you have one, it's a frozen labor market, right? I mentioned this earlier. There's not much churn. And so that's an interesting data point to keep in mind to square the anecdotes you hear. Wage growth, I just said it, but I want to kind of square that circle before I move on and talk about some other policy impacts in the macroeconomy, wage growth went crazy during the inflationary period of 2021 through 2023. And it's since starting to normalize back in the 3 to 4% range. What are you looking at now? Three different measures of wage growth. Either a simple measure, which is average hourly earnings in the orange line, or whether it's an index called the Employment Cost Index, the ECI. That factors in both wages and benefits. That's the dark blue line. And then my favorite measure is this light blue line, which is advertised wages on Indeed. It tends to go up as a leading indicator when the labor market is tightening, and it tends to fall faster on the downside when the labor market is weakening. So however you average these out, they're getting into that 3 to 4% zone. As I said, this is year over year wage growth. Keep in mind, this is nominal wage growth, meaning it is not adjusted for inflation. I'll show you some inflation figures in just a second, but inflation's below 3% year over year. So that's what I mean when I say that like wage growth is now starting to exceed inflation. But 3 to 4%, if you look back to pre-COVID, that's above those levels. So the 2016 to 2018 period saw wage growth in the 2 to 3% range. So we are seeing elevated nominal wage growth. So that's kind of the basic story of supply and demand in terms of the white collar recession, the disconnect of sitting down and standing up jobs, and then the normalization of wage growth. Oh boy, I'm having fun now. Like this is my, Golden Girls fan in me. Let's talk tariffs because this is the kind of topic du jour. I know I could talk about the one big beautiful bill and Medicaid cuts. I could talk about AI, but I think this is the dominant story over the past 60 days if you're following the news. And so it's truly extraordinary. I don't need you to see this data point. You probably know this is true. This is a measure of trade policy uncertainty. And we are in uncharted territory. So this index, it's basically crawling media reports for mentions of trade war, tariffs, all the different kind of trade-related issues that touch policy. And so you see, we're at a level of uncertainty that's more than double what we ever reached during the first Trump administration. So in 2018 and 2019, if you recall, there was a round of tariffs that the Trump administration then implemented, right? Steel, aluminum, washing machines, and China tariffs. But right now, the scope of tariffs that were announced on April 2nd, what the administration called Liberation Day, is unlike anything we've seen really in the post-World War II history. And so here's the chart to prove it. This is the average tariff rate. Now, I want to take a second here, just pause. What's a tariff? You may ask yourself. A tariff is effectively a tax on imports. It is a customs duty you pay. So say you import a $1,000 iPhone from China and say the tariff rate is 10%, you pay $100 in customs duties, you'd have a 10% tariff, right? And so this is averaging the tariff rate on all US imports going back over 200 years. And you see, we're back to the 1930s effectively right now, in that during the first Trump administration, if you squint, around 2018, 2019, the tariff rate went from 3% to 4 or 5%. Now we've gone from like 5% to 15%. Okay. The scope of this is nothing like the first Trump administration in terms of the breadth of the tariffs. And what's happened here, as we all know, if you check your 401k, which I don't recommend, in terms of the volatility, is that stock markets have been on this whipsaw, right? So in early April, we saw equity markets just globally decline very sharply. And what's happened since then is that actually they've rallied. We see the NASDAQ and the S&P 500 are now 5% above their November 1st levels. So they've recouped the losses that followed the rollout of the tariff. So this volatility it's connected to a disconnect, an uncertainty we have about future trade policy, right? That first chart I showed you of just extremely high uncertainty. And what markets are essentially betting on right now is that the Trump administration has two approaches to tariffs that they could take. One is use them as a negotiating tool, as a tactic to get people, other countries, to the negotiating table, strike better trade deals. And if that's the case, these tariffs are going to be temporary. And that's what the market believes right now. That's why equity markets have rallied. The other path forward, which again, it's confusing, but the administration has also outlined this, is that no. Tariffs are a permanent policy, maybe to raise revenue, maybe to reshore domestic manufacturing jobs. And it can't be both, right? And if it's truly the second, that these tariffs are in place as a long-term strategy, trust me, global stock markets will react in a very different way. But I think the bet now, if you've heard of it, it's the taco trade. It's a little derogatory towards the president, but it stands for TACO. Trump always chickens out, meaning that we're betting, equity market traders are betting that this is just a temporary negotiating tactic. We're not actually going to implement these tariffs at this level in perpetuity. However, this has real effects. This uncertainty, even if it's temporary, even if equity markets have rallied, what we're seeing is consumer sentiment declines. Whether you look at the Michigan measure, the Conference Board measure, after the tariffs were rolled out in April, we saw a pretty sharp decline in consumer sentiment, a bit of a rebound in the Conference Board measure. But the thing that's driving the souring sentiment of consumers is that they aren't dumb. I believe consumers, I believe households are really smart, actually. I think when you look at the economic literature, it's really consistent. Roughly 70 to 80% of tariffs are passed on to consumers as higher prices. And people know that. Look, this is a measure of consumer inflation expectations 1 year out. And that's the hockey stick that happened in April. People said, wait a second, my iPhones, my cars, they're going to cost more because importers can't just absorb all the tariff increases and not change prices. A lot of these margins are very thin. So people know prices are going to rise at some point in the medium term if, again, a big if tariffs are put in place for the longer term. But what if they're just a short-term negotiating strategy? Then that changes things. So this is how it's affecting consumers, but it's also affecting businesses. And so here's where I'm really concerned. I actually don't think tariffs on their own are like deadly. Here's my issue. I've talked to hundreds and hundreds of businesses executives, and the thing that they hate is not necessarily taxes or regulations. They hate uncertainty. Because if you can't plan for the future, you don't invest. And so what we see here is two lines from this New York Federal Reserve survey of business leaders. And the blue line is showing a sharp increase in the number of those leaders who say that they're going to decrease capital spending. And by capital spending, I mean large business investments, like big projects. So say, okay, let's say you're a manufacturing CEO. Do you build a new factory in Ottawa, in Mexico City, or in Texas? Well, if you don't know what the tariff rate's going to be in 6 months and it's changing every week, how about you just put that project on ice? You just wait it out until the dust settles. That's what's happening, and that's going to have a material negative impact on business investment in the short term unless this uncertainty is lifted. Again, even if you did have a sharp increase in tariffs, like maybe the administration wants that, the president believes in it clearly, okay, but just commit and communicate what's happening. So that's the kind of GDP outlook downside, is that business investment could sour. Time out. Imagine someone from the Trump administration's here. I want to kind of channel what their argument would be. Peter Navarro, maybe, right? Orrin Cass. So an economist affiliated with the administration who is pro-tariffs. What would they say? They would say, oh, Andrew, all that you just talked about, that uncertainty, yeah, that's the point. That's actually what we want. Because if you're uncertain about, do you build a factory in Ottawa or Mexico City or Texas, well, then build it in Texas because you know you won't have any tariffs. And so here's the headlines that the administration has been touting. Look at these figures, big, big numbers, right? Taiwanese semiconductor manufacturing company is saying they're going to invest $100 billion with a B dollars in the U.S. Eli Lilly, $27 billion. Apple, I can go on and on. Now, is this real? I would say maybe a bit of it's real, but I'm pretty cynical. I think a lot of these plans are mostly just PR. A lot of them, frankly, were happening anyway. You see this every new administration. It could be Obama, Biden, Trump 1.0. Every time there's a new president, there's a parade of CEOs who come into the White House and say, look at what we're doing because of you, Mr. President. I don't always buy that this was not going to happen otherwise, right? But here's the key thing. Even if it does happen, the types of facilities these manufacturers are building in the US are far less labor intensive. They're more optimized for robotics, using AI, and so on. The administration has a choice to make. It either wants to revitalize, have a renaissance of American manufacturing, or it wants to keep the goods Americans buy at a low price. And here's the thing, it can't be both. I mean, it's fine to choose one or the other. It seems like with this era of globalization, we've chosen the latter for decades. And it seems like the administration truly believes that maybe tariffs, or at least they're selling it as such, would revitalize these domestic plants. But when I look at these actual numbers and how they're investing, they're far less labor intensive. So think of Nike, right? Nike has plants in, factories in Vietnam and Bangladesh, and those are very labor intensive. The kinds of optimizations they would make if they reshored any of that would be far less jobs than you think and at far higher prices for your sneakers. So, where do we stand for the rest of 2025? I use that word uncertainty, uncertainty, uncertainty. Um, in terms of the outlook, let's look at GDP, gross domestic product, GDP. And I enunciate the D, the domestic, because here is what we saw in Q1. We saw GDP decline for the first time in 2 years. But here's why. The chart you're looking at are the components of GDP growth. And the lime green is imports. Imports surged in Q1. Why do you think that is? Well, probably because of tariffs. If you're a business trying to get that machinery in before the steel and aluminum tariffs hit, you were smart and did it before April 2nd. If you're a consumer, you maybe want to buy. There was a surge, as you'll see in a second, of retail sales ahead of these tariffs. But the point about imports here is that actually this figure, this GDP figure, is less negative than you think, because when you exclude imports, which I think that was pulling forward of consumer spending, it was front loading to get away from the tariffs. When you look beyond the international trade elements of GDP, the core components of GDP in terms of consumer spending and business investment were actually strong in Q1. But that's January, February, March. That's before the tariffs hit and the uncertainty associated. So, how do we know consumers front loaded? Look at this. We see really strong retail sales growth by basically every kind of retail category. You can look at your furniture, home furnishings, like your Home Depot stores. You can look at your food and beverage stores, your general merchandising stores here, the light blue. That's kind of like Target, Walmart. We actually saw an acceleration of retail sales growth. The annualized percent change in these categories was really strong. However, the inventories that retailers had that were priced in the pre-tariff era are depleting as we speak. Basically, through April and May, they had enough to satisfy consumer demand. But by now, June onward, those inventories are no longer being replenished by pre-tariff goods. They're being replenished by post-tariff goods. That means prices aren't likely to rise. So, which prices are going to rise? Let's go through this analysis from the Yale Budget Lab. This is where they looked at the actual, whether it's steel aluminum tariffs, whether it's Canada-Mexico tariffs, which are very strong in terms of the motor vehicle supply chain, or whether it's the China tariffs, very strong in terms of the apparel supply chain. Here are the types of price increases we're talking about. Metals, 33%. Apparel, 27% increase in apparel prices. I can go on and on. A lot of this is uncertain, right? Because this is an analysis done through June 1st. Well, what happened this week was there was some good news, sort of, announced about the U.S.-China trade negotiations, that maybe we got, access to some rare earth minerals, but only for 6 months. That could be unwound if, Trump and Xi have another tiff. So we'll see how this plays out. But I would say expect prices to rise over the summer, or shortages of goods in stores, or just a weakening in consumer sentiment as consumers balk at the prices and don't buy them. That is not great, because consumer spending has really been the engine that steered our economy away from a recession over the last 3 years. And here's how long we have in terms of runway. Consumer spending here in the in the orange, is growing at roughly 3% year over year. That's the kind of flat orange line here. By the way, both of these figures are real. The real is the opposite of nominal. So real means I adjusted for inflation. So real consumer spending is growing at roughly 3%, but real disposable income is only growing at 2.2% year over year. What's real disposable income? That's income after you adjust for inflation and after you take out taxes. So real disposable income for about a year now has been below real spending. So households can only do this for so long, right? It's like Roadrunner. You fly off run off the cliff. At some point you fall. How long do we have? Well, it depends on consumer credit and debt levels. We see higher leverage ratios. We see higher delinquencies and say auto loans and so on. It can run for a while now, but if you go back to 2022, the kind of draw your eyes to the left here, there was a period where we saw lots of negative real disposable income. The blue line right is below zero. That's when inflation was just eating away at our consumer spending power. But why did consumer spending not just fall off a cliff? This is why we didn't go into a recession, right? The orange line never went negative. The reason is we had a big accumulation of wealth from stimulus checks that kind of saw consumers through for a few years through 2022. But that has really, those excess savings, so-called, above and beyond the pre-COVID trend, have now been depleted. So this cannot continue in perpetuity. And in terms of the actual number one topic that the Federal Reserve focuses on, which is inflation, where do we stand? Well, it's not quite, mission accomplished, but we've come a long way. Consumer prices are down from the heyday of 2022, where it was 7-8% year over year, out of control inflation. We've seen it get close to, but not quite at the Fed's 2% target. And so if you just looked at this data, you'd say, well, we're in a good spot, right? Inflation, right, is only below 2% here, or below 3%. And I showed you wage growth, which is 3 to 4%. So this is good, right, Andrew? Again, I think this is all pre-tariff. Tariff prices have yet to really hit the inflation figures. So as I start to wrap up and take questions, I want to just kind of talk about where the Fed stands in terms of interest rates, right? The Fed jacked up interest rates in 2022 and 23 because we had the highest inflation in 40 years, kept them high through most of 2024. And then starting last year, the Fed started to cut rates. We saw rates decline about 100 basis points or a full percentage point. And then now the Fed is kind of like those business executives I mentioned earlier. They're kind of stopping at a wait and see mode, okay? And the markets here, the dashed lines in terms of the futures markets, what they expect is, geez, the Fed to keep rates at a pretty high level. We're not going to see rates decline. So I got to wrap up because I know we're getting at the end of the hour. I just want to kind of recap. Here are my three risks. Stagflation on the left, budget cuts, especially the Medicaid cuts that are in the big, beautiful bill on the middle, and then the calm before the tariff storm. I really do think this China-U.S. trade war is not over yet. So here are my other key takeaways for you to read. And I just want to plug one more time, Recruitonomics. David, Jeff, thank you for having me.